Hey guys, how you doing? Coach Keyon here, also known as Mr. Finance, your favorite financial educator and business coach. And today I'm here to tell you the truth about life insurance. Now, before I get into the truth of life insurance, I want to break down a few things that you must know about life insurance. The first ever type of life insurance that was ever created was known as a term insurance. Term means temporary. It covers you anywhere in the range of from 5 years to 35 years. The second form of life insurance that was evolved from term was known as a whole life. A whole life insurance was created because the fact that the temporary term insurance, most people was outliving those insurance and people wanted something that was going to last a little bit longer where the premium won't get changed and the costs go up and all these different things. So a whole life was created where people now have coverage for up until age 100 or more. And both of these products are considered to be fixed products. Did you know that only about 2% of term insurance policies pay out? And the reason why that is so is because most people outlive them. Yes, it's very true that term insurance is extremely affordable because you can acquire a lot more coverage for a cheaper cost. But two things you must keep in mind. You may outlive that coverage and the cost of insurance may be more as you get older because those are one of the things that help to determine life insurance when you think about the premium. Your cost of insurance determined about your mortality rate, your background check, and your medical background check as well. Now, the third form of life insurance is something called a universal life insurance. Universal life insurance was created because people wanted a little bit more flexibility. Unlike a whole life and a term, which is a fixed premium, universal life insurance created flexibility for families to have the ability to pay more or less or change their death benefit at a previous or different times. Then the fourth evolution of universal life insurance was something called a VUL, which stands for Variable Universal Life Insurance. So the V in Variable Universal Life Insurance stands for the fact that you are able to invest your money into the stock market. And when you do make money in the stock market in this vehicle, it allows you to get tax-free money. But the only downfall of this vehicle is that when the dot-com bubble burst, we've seen where a lot of variable universal life insurance took a major hit. Because when the market crashed, they lost a lot of money, which means that in some cases, some people's VULs were underfunded, which means that they may have to pay more in premiums. Or some of them might have lapsed. So now we're in the fifth stage of life insurance, which is known as an IUL, which is an Index Universal Life Insurance. An Index Universal Life Insurance means that the I stands for index, which means that your money is no longer in the stock market. So your money is never at risk. In an Index Universal Life Insurance, it provides you the ability to get growth. It also provides you the guarantee the safety, which means that you would never lose money in the stock market go down in the negative aspect. It also provides you with protection, and it gives you the ability to get tax advantages just like all life insurance. Now, one of the most important things you must think about is how to structure your life insurance if you're going to own it. The first thing you must learn is something called your DIME, your DIME. This is a method that is used to tell you how much life insurance you may need. So before you own any type of life insurance, you must calculate how much debt that you need to be covered. What is your annual income multiplied by 5 or 10 years? What is the balance on your mortgage? And what is the educational planning for your children going to cost you? So God forbid if you die too soon, all of these things will be taken care of even in your absence. So that's the reason why we tell families, and I want you to know importantly that there's no such thing as bad insurance. Life insurance is based off two things. Is it suitable for you based off your dime? And is it affordable for you based upon your budget? So if I was you and you was I would structure my life insurance ownership in this manner. I will own a final expense insurance because that's the only insurance that's going to pay out within 48 hours of me passing. Unlike your life insurance, it's going to take anywhere from 4 to 6 weeks depending on how you passed away. I will own a term insurance to cover my dime. So if I passed away too soon, all my debts, my income will not disappear for the next 5 to 10 years, and my mortgage will be paid off, and my kids will still have money for college. And at the same time, I will use a cash value life insurance to save the difference in, because I'll be able to put my money in a vehicle where I can get the growth, the safety, the protection, and the tax advantages. So when you think about owning life insurance, think about creating a stronger financial foundation and why it's important to structure proper protection. If you'd like to learn more, reach out to a financial educator like myself. So that way we can educate you and not just sell you. I hope this helped. If you like this, share, comment, and definitely like. And give me a follow too. If you'd like access to my free workshops and classes, Text the word I am ready. See you there.